Welcome, everyone. Really appreciate you being here. I'm Jonathan Moe, I'm on the Stifel Venture Banking team. I'm a VP here. I do a lot of different things here, but one of the kind of areas I focus on is working with the community and outreach. We hold a lot of events that I help organize. We also are starting to hold more kind of online webinars like this one. And in this case, of course, we are hosting Flowlie, which is a really cool product. I have the founder and CEO Vlad Cazacu here with me. He's going to be leading the webinar. I just want to spend maybe less than 2 minutes, tell you a little bit about Stifel, and then tell you what we're going to do for this webinar. And yes, we're going to be allowing people to kind of like trickle in. There'll be so a few people adding. That's just other guests. Okay. So I'm with Stifel, based here in New York City. Stifel is one of the largest banks in the United States. We have $500 billion under management. In terms of like what the venture banking group does here, my group, we work with early stage founders, early stage startups, and do everything from basic banking for them. So open checking accounts, we do treasury management, we provide yield and pay yield on deposits. We give them credit cards. We write checks for them. We do wire transfers. Okay, so that's kind of like that part. We also do venture debt. So this is where early stage startups, almost always backed by venture capital investors
Hey
already,
there, Mickey.
will
How you
receive
doing?
venture debt. So this is where
No?
we will give them loans. Um, and typically we work with any type of startup. There are certain areas where we're maybe less prominent. So, for instance, if you're doing biotech and a lot of the debt is going to finance R&D, that could be a little bit more difficult. But for the most part, we're very open, and we have several hundred uh, startup clients which have received venture debt. And of course, we're nationwide. So we have a team in New York, we have a team, of course, in Silicon Valley, as well as Los Angeles. We have a team in Atlanta, and people in Boston as well, and a couple people in between. Stifel itself is headquartered in St. Louis, Missouri. So yeah, that's kind of us. I'll mention quick. We also bank venture capital firms. We have several hundred clients there, so we are the banker for the actual firm, and we also give more exotic kind of credit products to venture capitalists. Things like capital call lines, and also GP stakes. So when a GP needs to contribute, we actually lend to them so that they can start their fund. So yeah, that's kind of that. These are new, these types of webinars. So this is where we're featuring kind of products, mostly software products, that we think are really interesting and that are, in this case, specifically built for founders, although also VCs as well. And yeah, Vlad has a background on both sides of that as a founder and an investor. So I'm going to let him now take over. We'll also have some time for questions at the end. So we're scheduled to go past the hour. So 2 to 3:30 Eastern. We hope you can kind of stay with us. And if you have questions at the end, happy to do that. And of course, if for whatever reason you can't stay the entire time, I'll make sure that all the contact information goes out via the Luma so you can follow up with everyone. Okay, Vlad, welcome.
Awesome. Thanks for the invite, Jonathan. Really appreciate it. I'm super excited to do this. I know it's been in the making for a while since our first
Yes.
conversation of doing a partnership between Stifel and Flowlie. So I'm really happy we're doing this. And thank you all for joining. Really appreciate it. My name is Vlad, co-founder and CEO of Flowlie. And today we'll do a webinar on fundraising fundamentals, something that we have quite a lot of expertise in over the last few years on the founder side, but also a number of years prior on the investor side. And we're going to make a blend of education with just overall explanation of how can Flowly help with some of these things. It is in no ways a sales pitch, and I'm not here to sell you anything. We're here to educate you on some of the best tactics and strategies around raising capital in today's market, and also give you a little bit of an overview of how Flowly platform could help with some parts of it. A quick background on me, I'll spend less than 30 seconds on this and why am I somewhat qualified to give this webinar. I'm originally from Bucharest, Romania, came to the States and then spent my whole career in venture capital, initially with FVC, then View Venture Partners, then led the Southeast for a multifamily office group, and then went over to a later stage firm. So did about 100 almost 120 investments throughout that time, like 11 of those, and I still co-manage a portfolio with my ex-managing partner and been an active angel investor since as well. So literally everything that I've done before Flowly was venture capital investing, and everything that I've done after Flowly has been venture capital investing support on the founder side. So with that being said, the agenda for today is really two parts. One, we're going to spend some time on the fundraising strategy. This is a mix where we're going to start a little bit with some legal fundamentals and why they matter a lot, just to make sure we get that out of the way. And then from there, talk a little bit about valuation, dilution, how to run a tight fundraising process, and some strategies to target the right investors for your raise. On the second part, we're going to do a live demo of the Flowlease platform, and we're going to spend some time there to show you some of the functionalities that we've built to help streamline some of the things we're going to be learning in the first part. As housekeeping, I do like to keep any webinar or education session that we do as open as possible. So if you have any questions, feel free to drop them in chat, or the raise hand feature in Zoom. We also have Bianca, our VP of Partnerships, joining us on the call today. She'll be able to answer any questions on the chat, point to some new resources. And if by any reason I'm missing, a hand raise or a question, she'll let me know to pause the webinar and get that answered for you. So, don't need to hold the question till the end. So, with that being said, starting very briefly, I promise we're only going to do legal for 4 minutes, but I do want to point out a few things because we've seen a lot of founders, unfortunately, go out to raise without some very quick background on the legal foundations and why certain things work and don't work in a venture. Um, there's, some of you may know, there's effectively two ways to create a company in the United States, where there's a variety of more in partnerships and other things. But for the purpose of majority of companies are either a limited liability company or a C corporation, and any organization, any state outside of US also has a very similar split. Now, the primary difference between the two is that the C corporation creates a very different entity altogether from the owners, and has a lot of benefits as a result of that, primarily in terms of liability protection. The people who are suing the company, not the owners of the company, and taxation. The company itself is taxed independently of their owners, which is both good and bad in certain regards. But there's a lot of other benefits to it, in the sense that you can issue stock options. There's much easier setup of ownership transfer, and in some cases, you can qualify for very attractive tax benefits on the investor side. The reason why I'm telling you all of this is because 99.9% of investments that are happening in the venture capital space are happening in C corporations, which is really, really important to understand, because we've been approached, and I've been approached and asked by a lot of founders, specifically earlier stage and first-time founders, angel, pre-seed, etc., that are going to market with a limited liability company, LLC, and they're asking me, like, would I just have time to do this switch later on? And my advice to everyone is, you want to clean house as much as humanly possible before you go out to market to raise. And the legal fundamentals are probably one of the easiest things to take care of before, because it's a very straightforward process to do a conversion, or if you're not incorporated, to actually have a C corporation out there. That's going to help you tremendously in those conversations, specifically around due diligence. When people are going to start digging into the legal documents and financial documents of the company to understand, is everything looking right, they're looking at things like this. So if you heard any feedback or any advice from anyone else, don't worry if you have an LLC, go raise capital and then you'll figure it out later. My personal suggestion to you is ignore that advice, get to a C Corp as soon as possible. With that said, now that you have a C Corp, you'll have the question of, when you go out to raise, what will you actually raise? Like, what are you actually transacting? And I want to make sure that people are familiar with these four terms, because they're going to be really important to keep in mind throughout the rest of the presentation. So let's just do like quick vocabulary share. Shares, the part ownership of the company, come usually in two different shapes: common and preferred. Common is what's usually held by employees and founders, and they have everything that preferred shares have, without, let's call it, some additional preferences, for the lack of a better word. They're common, meaning they have full ownership participation, they have voting rights and everything, but is the pie split into common pieces. For a long time in your company journey, and I mean sometimes as early, as late as seed, and in some cases as late as Series A, you will only have common shares. Do investors buy common shares? No, they do not. So if they don't buy common shares, what do they buy? In later stage, so seed in some cases, Series A, B, and C almost certainly, investors buy these things called preferred shares, meaning they have certain rights on top of the founders and employees. They have the same participation in ownership and voting, etc. They just have certain protections that are easier for them because they're taking some risk on you as a founder versus you as a founder, you're dedicating the next 10 years of your life and you own a much larger piece of the pie. Now, if you're not selling preferred shares, then the natural question that follows is, okay, what else do you sell? Investors give you money. What do you give them in return if you don't give them shares? And the answer to that comes in two different flavors. One is this concept of a SAFE, a simple agreement for future equity, that's been initially, let's call it invented, coined, designed, however you prefer, by Y Combinator, and it's since become the one of the most fundamental fundraising instruments for early stage founders in the United States specifically, and in some modified variations also internationally. A SAFE is neither debt nor equity. It's simply a contract that tells the investor on this price, let's say, or on these terms, we will give you preferred shares in the future whenever we will do this preferred share issuance. Now, why do people choose to do a SAFE versus actually issuing preferred shares? Usually the answer to that comes in cost. In the case of a SAFE, you download it from the Y Combinator website or use a generator in one of the platforms that you may use for cap table management, let's say Carta or Pooley. All of those tools now have a cap table, a SAFE generator. It's free, it's standard. You should not be changing anything with it with the exception of the two terms, how much they're investing and what's the price of it. And that's it. In the case of preferred shares, you will have a legal team involved in it, meaning it can take anywhere from a few weeks to over a month. And in terms of dollars, it can be anywhere from 20, $30,000 all the way to 300 to $400,000. And some people think, well, that's a lot of money. And how on earth would you end up spending so much money selling a piece of your company? A friend of ours, and actually also a customer of Flowlie recently closed a Series A, and their transaction bill from the lawyers was $350,000. Now there's a lot of complexities with it, but just to give you perspective, that's why I usually don't issue preferred shares early on. Now the alternative to a SAFE, it's what we call a convertible note. Now the most important thing to know is that a convertible note is debt, so you are taking debt on your balance sheet. It will convert into equity, but for the time being, it is debt. It does accrue interest over time, meaning that the longer you keep it there, the more interest it accrues. Um, and also can have all the valuation cap and discounts. Looks very similar to a SAFE. It just has this, different nuance, but it is more complex in terms of the actual document. Meaning, I would not encourage you to draft a convertible note using ChatGPT and then getting your investor to sign it. You're probably going to get a legal counsel to just draft that for you. It's 7 to 8 pages, and you'll pay, some amount of money for it. So you can see here how SAFE is the simplest, solo to do, convertible note a little bit more complex, a lawyer may be required, preferred shares very complex. Now, before we jump into the next thing, the one thing that I want to mention is having seen hundreds upon hundreds of transactions being done, let's say that we participated in, early stage specifically, so angel, pre-seed, and seed. One of the biggest mistakes that I see founders do earlier stages is sign a convertible note with some initial investors when they have no understanding of how long will it take until they actually issue any preferred shares when they do this price round, we have VCs coming in. And the reason why I say it's a big mistake is because this interest keeps accruing month over month, year over year, and then you'll end up giving a much larger percentage of your company to the investor for the exact same amount of money, which just does not work in your favor. So if you're very early stage, I would recommend going with a SAFE and only using convertible notes in what we call bridge financings, meaning you are in between preferred shares issuance. You are between a Series A and a Series B, or between a Series B and a Series C. You want some additional capital, and you want to use a convertible note for that. So with this 2 slides only on legal, we will pass on to let's call it the more math part of it, the valuation. And then I promise the rest is going to be just process. We'll keep all the hard legal and math stuff towards the beginning of the webinar. So when we're looking at early stage venture, what are we seeing in terms of market data? And that is a combination of our own flow data as well as data that we have from third-party providers. When we're looking at angels and friends and family, this is the first time we're seeing these raises of 52 to 150K that are entirely pre-product, pre-MVP, as the only raise available to founders who are pre-product. Now, that may sound ridiculous to some of you, and catching myself say this, maybe even a year ago, I would assume it would have been ridiculous. But as early as pre-seed right now, which again used to be the earliest form of inception of a company, we are looking at folks who are requiring an MVP in market, some form of product out, 1, 2, 3, 10 users, people actually providing some feedback, ideally the first customer or so. The era of pre-seed on just an idea is now entirely reserved to a small elite of Silicon Valley founders and not really available to the remaining 99.99% of the population. Seeds are where we're now seeing the requirement of somewhere between 350, 400, all the way up to 500,000 of ARR. And again, that used to be a great Series A candidate a while back. It's not anymore. It's I would say, median seed performance. Those are the rounds of 1.5 to $5 million, which has also increased in size significantly over time. And the benchmark for Series A right now is somewhere in between $2 and $5 million of ARR. Meaning, as a software company, you'll be a good candidate for a Series A the moment you cross the 2 million and are in this 2 to 5 million range. Also, the amounts raised by people in Series A have grown significantly to 5 to 25 million, and in some cases much larger. But again, we're going to take the outliers out of the conversation for here. So this is how the early stage landscape looks now. I'm not going to go over the valuation ranges because you can see them on the screen, but just want to give you a sense of what are the expectations of the market as you go out in towards the end of 2025, beginning of 2026. Now, if you are a hardware company, that's going to look a little bit different, right? In the sense of a hardware company, you may not have the same expectations as a software company because the cost of building software is significantly lower than the cost of building hardware. But what we're seeing at pre-seed is some form of technical planning and production clarity over how that will actually get produced. Ideally, some form of contract if you are producing it with a third party, with that third party having been identified. In terms of seed, that's where we're starting to see ideally some LOIs or orders for future fulfillment in case you're selling enterprise, or any design partner if you're doing something more complex, let's say in the space technology or defense tech, where you may be working with a governmental agency for your particular product. You may be, again, have some of these contracts and agreements in place without actually having built the hardware itself. Whereas Series A, that's what we're talking about, bare minimum orders out, fulfilled, revenue coming in, and having the proof point that you can actually move a product from concept all the way to a final customer. This has been increasing significantly over the last 5 years. So just want to give a word of caution because I think we're still not yet mentally over 2020 and 2021. I think from a market perspective, we may still be somewhere there. We're not. It's been 4 years since. There's been a lot of velocity in the markets during that time, and a lot of exuberance, for the lack of a better word, where deals were being done at sky-high valuations, and that's not happening anymore for the vast majority of deals. And again, the exceptions will always confirm the rule, not necessarily prove it wrong. I want to spend a few minutes to show you how some of these things, and I won't make the claim that all these things will be solved. But a big part of what we've been working on for the last 2.5 years is trying to create a system that actually leverages data analytics to help founders more predictively raise capital. And we were successful in doing so for a little bit over 3,000 people now, that not all of them raise capital, right? That's, it's not something that, we can promise. So some of them did and some of them didn't. But the ones that did, they raised a little bit over $600 million over the last 2 years. And we're really happy to see that, because we know that's dollars that may or may not have been raised without, Flowlie. So I'll start with what Flowlie is not, because it's, I would say, equally important than what Flowlie is. Flowlie is not a marketplace. Flowlie is not a place where investors and founders meet each other. That's not what we're building. So what is Flowlie then? Flowlie is a place where you can do, in some cases, investor research, meaning you can navigate our database of investors and firms. You can do a manual search, or you can let our AI do a search for you. Let's say, in this case, investment firms. And what we're going to see here is a list of firms ranked by what we call fit scoring, meaning we've trained the model on all the transactions that the investors have done in the past. And we use that information to effectively create profiles of those particular companies. So let me just give one of the firms. You will again be seeing in-depth profile of that particular firm, their industries, their business models, their product categories, check sizes, etc. The team that works at that particular firm. You can also see just the investment team if you want to, and remove anyone in the operations. You can see their portfolio of the companies they've backed, etc. And then we use all these data points to calculate how well of a fit you are to that particular investor, which allows you to start creating lists. You may say, I'm creating a list for my New York City trip or for my Series B, etc. Lists are effectively ways to create groups of investors you want to get in touch with. And I'll try to minimize Zoom a little bit so I can see my full screen. So I can add people to a list, and then from there, once you have this list of high fit investors, then exactly what we discussed in the presentation is how do we get in touch with them? And we said warm intros are a great way to do so. So, we made this button as big and as purple as you can get. You click it, and you select the people in your company that you want to run this for, and you click confirm. And what this will do is will actually send up a number of agents in the internet and try to see if there's anyone that you are connected with, so people in your professional network that may be connected to the people you're trying to get in touch with. And how that shows up, and I can go to all connections right here, shows up like this. So this is a list of all the professional connections you and your co-founders have, ranked by what we call the network value, meaning how valuable is their network for your particular fundraise. That means that if someone is connected with both Jonathan, Bianca, and I, but Jonathan is raising for late stage fintech, Bianca is raising for a mid stage healthcare, and I'm raising for an early stage future of work company, the same person is going to have a different network value in our Flowly instance, because they may have really great connections for Jonathan and Bianca, but not that great connections for myself. And when you click into one of those people, let's find someone with a few intros so that the graph is not too large. Let's see, Sheila right here. You're going to look at the intro paths. You're going to see that the system detected 23 intro paths facilitated by her. And you can see it more easily as a graph. You can see the people that were connected with Sheila and the relationships that she holds that we may or may not want to get in touch with. So these are the investors that we were able to identify were intro paths to, which makes the process of finding intros a little bit more efficient, because all you have to do is go to network analysis, all connections. And if you know the people at the top, I would go from the top to the bottom. And those are, again, ranked by how valuable they'll be for your particular raise. So step number one, investor research, use our AI or do the manual search to identify the right firms and people at those firms, or browse some of our curated lists, meaning you can check out lists that have been created by our firm, by our team, for specific industries and verticals. You're going to create them in your own list or import them, and you're going to find the intros towards those people. Once you found those intros towards those people, let's go to Gaurav here has a great graph. I remember you can go and see, okay, who are the people that we know that know them and how well do they know each other? In this particular case, it looks like Van Newman, one of the co-founders of this firm, knows San Saunders, and this guy is the best intro path towards Gaurav. So whenever we're trying to figure out how we're going to get in touch with Gaurav, Flowlie can give us that answer, which again saves you a lot of time in the process of research. Now, once you've done all this research and start activating those paths, you're going to start having meetings with people. And at that point, you're going to use our investor pipeline. Think of it as a vertical CRM that's designed for fundraising. It has everything that you need to customize the pipeline, manage all your stages. You'll be able to track things like source, priority, commitments amounts, why people are passing. So you can run analysis on that later on, shortlist them for next round, add them custom labels, etc. You can do it in a list view. You can do it in a Kanban view if you're more of a, Jira-like or Asana-like person. You can easily just drag and drop, people around and use this to keep yourself organized. Now, one thing that I'll say is it is paramount that you keep track of all the interactions you're having when you're fundraising. Why is that the case? Is you're going to start having a lot of conversations with people. And it is very, very difficult to keep everything in your mind. I know some people that have done spreadsheets. I know some people that have done whiteboards or just pen and paper. I can assure you that being organized and having proper notes and research in one place, it's going to be an advantage when things just get busy. Then you're going to be in one place able to go and see the context of that meeting. Now, the last piece that I want to show you is the investor meeting. So there's a few things to it. One, you can connect your Google Calendar and will automatically detect all the meetings you have with investors. We're going to import them in Flowlie. You're going to be able to toggle on the note taker. So for future meetings, you can have the Flowlie note taker join that particular meeting, and we'll be able to go to the meeting, record it, and transcribe it, and give you the result back in Flowlie. Once you start having multiple meetings with the firm, you're going to start seeing how all these data aggregates in one place, and it's going to be super helpful to track who you met, what was the highest rank you've met at the firm, and what momentum you have with that particular firm. But also with the transcript, which by the way doesn't have to be our note taker. You can also just import your own transcript from Fathom, Google Meets, Zoom Recorder, whatever you're using to record your meetings. We fine-tuned an LLM on things like key discussion points, investment thesis insight, sentiment analysis, points of interest, and points of concern. So it's becoming really, really good at extracting this data from the meeting. And people have leveraged the points of interest and points of concern to write really thoughtful follow-up emails to those investors, as well as map all their to-dos and tasks in one place. So you can also use Flowlie as a task management. So to overlap what we talked earlier, never run off top of funnel. Use investor research as much as possible to find as many investors as possible using our data set. Find the warm intros. That's where network analysis comes into play. Use our system, connect your LinkedIn's, connect your Google, allow us to identify who do you know, and then we'll do the work to predict how well those people know the people you're trying to get in touch with. Investor pipeline, just be diligent and be very precise about the tracking that you're doing, about all the meetings and all the notes and all the conversations you're having. And last but not least, investor meetings. Make sure you have them analyzed, understand how that meeting went, record them for your future use, and have everything in one place. And that's what we do at Flowlie. It's a system of record and system of work to help you navigate fundraising more efficiently. It's not a marketplace, and it's not designed to, buy warm intros or do any of that stuff. It's designed to sit behind the scenes and help you be much more efficient in that process.